Hi, everyone. We'll just hang tight for a couple of minutes as we allow people to join. Looks like we have about 50 people attending so far. I think we had roughly 500 registrants, Diego, is that right?
Yeah, that's what we were told.
Awesome. And so, yeah, excited to have everyone here. As people are coming in, I would strongly encourage everyone to use the chat feature to ask any questions during this presentation. Me and Diego usually tag team this. I do a lot of talking. Diego does a lot of answering of questions in the chat. And then Diego will prompt me to sort of discuss issues that might be, more commonplace that come up in the chat. So then we can, have a discussion around it. All right, awesome. Yeah, then let's go ahead and get started here. I think we're getting closer and closer to the 100 mark in terms of participants. That's exciting. And so let's jump into it. Quick disclaimer, we're not here giving you investment advice, etc. We are not your anything. This is just sort of information, right? So keep that in mind. We'll give a quick intro on me, myself, Diego, and then on Juno, our company. When we talk about, grad school in general, but also specific degree programs, budgeting gets very, very important. So we'll talk about that in detail. That usually segues into a conversation about, okay, I need a little bit more money than I have. How do I fill the gap? And student loans often comes to be the solution for that. And finally, we'll talk about Juno's 2025 deal, which is, I would say the most popular loan option for most people going into MBA programs, law programs, few other grad programs in the US. And finally, we'll do some Q&A. Again, like I said, we'll do Q&A throughout the session, but we'll also do more Q&A at the end of it. And it's not unusual for this session to like have 15, 20 minutes of Q&A at the end of it. So stick around for that as well. All right, cool. So my name is Nikhil. I went to U of I, did my aerospace engineering, hung out at Boeing for a few years, had a lot of fun, but got bored of that ultimately. Came to HBS, did my MBA over there, and started Juno as a way to pay for my student loans while at HBS. Diego?
Hey everyone, thank you for joining us. I'm Diego. As you can see, I am originally from Mexico. Did economics as a major in undergrad. Spent a few years in investment banking, and then did my MBA at Chicago Booth. As you can see, graduated class of 2022, and joined Juno in the process. Been here ever since.
Awesome. So what's Juno? Juno is like this group bargaining effort for getting lower rates on student loans, right? So these are some of the original screenshots on like how it started, and it kind of operates the same way today, except we are, a little bit more structured than a Facebook group can be. And that particular year, and really the number has stayed pretty consistent. It's actually grown a little bit. People saved roughly like $13,000-14,000 compared to their federal loan alternative, which was sort of the most popular option back then, right? So we were able to create this new option that's substantially more affordable than taking the federal student loans. At this point, over $1 billion have been originated through these negotiated deals at most of the top programs. 25-30% of the incoming class is utilizing Juno. So it's quite ubiquitous amongst the MBA programs. So before Juno, folks would go shop around, check out different banks, and Juno essentially creates a new option amongst the set that's really designed to be the lowest rate option for almost everyone, I would say. I wouldn't say every single person, but almost everyone. And then we also have certain features that help bridge that gap if needed. Okay, so that's a quick intro on us and Juno. I'm noticing we're crossing like the 125 mark on participants. That's exciting. So we'll keep going on budgeting, right? So one of the big things we like to sort of highlight and make sure people are not surprised by is like the cost of attendance number on the school's website is probably an underestimate, right? And I choose the words on this page very carefully, right? I say schools underestimate the median cost of attendance. What I mean by that is there's plenty of people who live within the cost of attendance published by the school, right? But the median person or the majority of people are spending more than what the school publishes. We strongly suggest everyone does sort of their own budgeting exercise to figure out like how much am I likely to spend, right? And so we have this, and when we suggest doing that exercise, oftentimes the question is like, I have no idea how much, all the social activities and all the travel, etc., is going to cost, right? Like how do I predict what that's going to be when I get into business school? So we've run this survey now for 2 years, 3 years. And we think it's the most comprehensive survey that exists on the topic. And it kind of tells you, how much are people traveling, how much are they spending on those trips, first year versus second year, and it kind of gives you a distribution. So then you can start thinking about where do I lie in that distribution, right? Am I one of the people who's going to travel a ton, right? Am I one of the people who's going to travel, very little, right? Or am I somewhere in the middle? So you can use this spreadsheet, juno.us/MBA-estimate. You'll get this deck later, so you can just click on the link. But it'll give you all the categories of expenses worth thinking about. Amongst them will be travel. So you can use the survey to kind of find like, okay, I sit somewhere here, so I'll probably need $8,000 for my travel expenses. And then figure out, the funds you have available, your cash in your bank account, stocks in your brokerage account, student loans that you might take, income that you might have, either your own income, spouse's income, your internship income, stuff like that, right? So it'll help you think through all these categories. And at the end of it, it's trying to end up saying like, hey, do you need loans or not, right? Maybe you don't need any loans, maybe you do need some loans. One thing that we like to talk about is not graduating broke, right? So, I graduated in May of 2020, COVID year. I think we all see the headlines today on like, job reports from MBA programs, etc. What we find is MBAs usually land on their feet, but sometimes it might take like 3-4 months post-graduation, right? And if you have a little bit of a cash cushion when you graduate, that's going to go a long ways in making sure that you don't sort of accept the first job that shows up for the sake of making sure you can make your payments on your student loans. Rather, you are thinking about your career holistically and saying, okay, hey, I think I can risk waiting for another month or two. I'm in the pipeline for XYZ job, and I'd rather see that through, right? As opposed to sort of taking the first thing that shows up. So we do suggest, if you have the luxury of doing so, keeping a little bit of a cushion when you graduate in terms of, cash. Okay. So with that, that's a good segue to talk about student loans, right? So what's the process look like? It's fairly straightforward. We like to think of it as first you want to figure out how much you want to borrow. And we'll talk a little bit about that, how to figure out how much to borrow. The second thing you want to figure out is where you want to borrow, and we'll talk about that a little bit more also in terms of the pros and cons of the various options that are available. And finally, once you decide how much and where you want to borrow from, you complete the process associated with where you're borrowing from, right? One thing we'll say is as we talk about figuring out how much you want to borrow, um, don't overstress it, right? At the end of the day, you can increase or decrease the loan amount in the middle of a semester if you have to. It's a good idea to like, plan ahead, but worst comes worst, you can figure out a way to adjust the loan amount if needed. So the first thing I like to mention, which sometimes is a bummer for people, is like the cost of attendance is the maximum you can borrow. Actually, specifically, it's the cost of attendance minus scholarships. That's the maximum you can borrow from any student loan, federal, private, combination, whatever, right? And this is really controlled by the financial aid office. So every student loan gets certified by the financial aid office. And during that certification process, the financial aid office is going to make sure that you are not borrowing more than the cost of attendance minus any scholarships. Okay. So you might say, wait a second, Nikhil, you just told me 2 seconds ago that I'm going to spend more than the cost of attendance. And now you're telling me I can't borrow more than the cost of attendance. So what does that mean? That means if you think you need to borrow more than the cost of attendance, you need to borrow it from some solution other than student loans, right? So typically it's like you're using your cash savings, or you're using stocks, or you're using some other, friends and family. There's a credit card hack we can talk about later, but those are the kind of solutions you're using to bridge the gap between cost of attendance published by the school and the true number you end up spending, right? Obviously, the internship income can help in bridging some of this gap. In some cases, you might find yourself in a situation where you can't find that money, right? You don't have cash savings, you don't have stocks, etc. In those situations, what you want to do is make sure that you're living within your means, right? You're making sure you're not spending more than the cost of attendance, and you're living within your means. It's totally possible. Plenty of people do it, right? Your experience might look a little bit different, right? You might not travel as much. Your trips might not be, involving flights. Instead, you're going to a local ski mountain, right? So there's ways to manage that and have plenty of fun during the programs, but you just want to be very conscious of that, because it's very easy to go over budget when you surround yourself with so many activities going on. And finally, you can customize your cost of attendance, right? So you kind of look at the cost of attendance on the website. It looks like this thing that's set in stone. That's not true. So you can appeal to the financial aid office and tell them like, hey, my cost of attendance is actually higher because of XYZ reason. Can you allow me to borrow more, right? And you want to be careful about what kind of an argument you make with the financial aid office, right? You want to appeal to the need of the situation to complete the academic rigor of your program, right? So if you say, I need a laptop, almost every financial aid office is going to say, okay, $1,500 more for a laptop, right? If you say, hey, I have a dependent and therefore I need some more money, many financial aid offices are going to say, okay, $15,000 more to manage the expenses of your dependent, right? If you start saying like, hey, I need to participate in these social activities, travel, yada, yada, they're going to say, well, you can graduate without that. That's not required. It's part of the program. So just be careful about what argument you make. If you want to send a note to us before you send a note to the financial office, we're happy to review it, right? So hello@joinjuno.com, type up your note, send it to us, be like, hey, and we can opine on what we think might happen or suggest some edits that you might make to strengthen your case. All right.
I think, Nikhil, I think this is a good opportunity for you to touch base on a question that we have. Someone's asking, like, let's say you apply for a loan at the beginning of the school year, but then you realize half the way through the year that you need more money. Like, how would that work, right? You need a new loan. How does the cost of attendance works in that scenario?
Absolutely. Yeah. So let's take that exact example. Let's say it's you took your first loan in August, that money was dispersed, and then you call it in October, you realize you need a little bit more money, which is not uncommon, by the way. This happens. You just apply for a new loan at that point of time, right? You're still going to be subject to the cap, right? So the aggregate of your loans, that first loan you took and the second loan you took, the combined amount has to still remain below the cost of attendance minus applying for a loan later. But if you borrowed less than the maximum, then you can move upwards towards the maximum if you need to. One thing we often see in terms of a strategy, right? Because like Applying for a new loan means you're going through the whole process again, right? What we often see is people apply for the maximum that they're eligible for, borrow that amount, right? And then if they see like, hey, I actually don't need this money, right? They prepay the loan. And the only downside of that is like between the time you took the money and you return the money, interest is accruing, right? So that's the downside. But when you run the numbers, it tends to be, pretty small if you're talking about like a month or 2 months of interest accruing. So the convenience of it might be worth it, but you don't have to do that. Obviously, you can take loans as you go if you prefer. Okay, how much they should borrow, right? They're like so torn. They're like, I have these stocks. Oh, should I sell them? What should I do? Like, look, if you have conviction on a stock, right? Right now, my wife has conviction on Broadcom. I don't know why, but she has conviction, right? Obviously, don't sell those stocks, right? Like that's just, that is what it is. Now, if you have a broad, diversified portfolio or something like, VTI or VOO, one of these, index funds, I think there's an argument to be made. Like you can kind of do the math on it, right? Now, if my Fin 101 professor was here, he would shoot me for, he would fail me in the class for saying what I'm about to say. But, you could theoretically say like, hey, I'm earning 7 to 10%, whatever, pick your number in between that. Different people have different opinions about that. But let's just say 8, right? I'm earning 8% in the stock market. If I get an interest rate that's, below that, I'm just gonna let the stocks ride and pay the interest on the loan because my net worth is higher by doing that, right? The second thing to consider is like a taxable event. A lot of times, if you sell, $100,000 of stocks, you only get $90,000 to put towards school because $10,000 have to go towards taxes or something, right? And that's often the case with people who've had longer careers because they've invested over time and those stocks might have appreciated, especially if you've you know invested in the sort of pre-COVID years, etc., when we saw a lot of appreciation in the stock market. It may not make sense to sell those stocks, right? Because you're taking 10% hit, you're realizing the gains right now, so you're losing the advantage of tax deferred growth, right? So it's worth thinking about, right? And we can help you do the math on what that would look like. The problem is you're not comparing two certain outcomes, right? And that's the reason why my Fin 101 professor would not be happy with me. It's like you're comparing paying interest on a loan, which is a certainty, versus comparing, a performance of a stock portfolio, which is not a certainty. So there's ways to take that volatility into account, but for the simplicity, we try to think of it as like two comparable things, especially on a longer term basis. If you're thinking of a long term horizon, it's not that much of a stretch to make that argument. But if you're thinking of a short term horizon, like 2-3 years, you probably just want to sell your stocks, right? That's that's probably where it comes down to. Okay. Cash really in between each other pretty easily. Graduation, right? So if you have the luxury of some cash right now, try to hold on to some of it so that you don't graduate broke, right? And we try to do the math on like, hey, what's the cost of holding on to some cash, right? So if you stuck that cash in a high yield savings account and you end up with like a 7.5% interest rate, which is not unusual right now, you basically paid $1,900 to have $30,000 sitting around for 21 months, right? It's not cheap, it's not expensive either, but you can kind of see how one career decision, is worth $50,000, right? Or in a single year or in a lifetime could be worth millions of dollars, versus $1,800. So we do think about it. The other thing I'll add is like, right? You're not like, hey, I'm consulting, I'm going back to consulting, right? That's not you. Or like you're like, like if you haven't defined your career path and you're open to exploring, and you're potentially exploring entrepreneurship or buying a business, which is something people get introduced to pretty commonly these days in business school, and many people pursue it. Having a little bit of cash can make a dramatic difference in your outcome, right? For example, if you think about even Juno, if you think about it, right? Like we didn't raise very early in Juno, right? We were fortunate that I was supported by my spouse. We didn't sort of feel the pressure to go and raise money. And because of that, we were able to raise at a much later stage after having proven out a few things, after having, almost $1 million of revenue. And that obviously got us a great valuation, allowed us to raise, very comfortably on our terms. If we raise too early, we might have diluted ourselves 20-40% more than what the current situation is. So they're just simple examples like that, where having a little bit of cash sitting around can make a dramatic difference in your outcome. Same thing with buying a business. If you try to buy a business with 100% external money, no skin in the game, the terms you're offered is much worse than if you had a little bit of cash to bring to the table, and suddenly it can make a difference. In the fourth, fifth year, it can make a difference of a few $1 million in terms of outcome. So it could be very substantial, right? And lastly, I added this slide recently because this is, you're getting now the perspective of someone who's like 5 years out from business school, right? So the folks who focus solely on minimizing the loan, right? They graduate, they don't have much of cash balance, they don't have any stocks to their name, so they're like rebuilding from zero in terms of the assets they have to put down on a down payment on a house, right? And in some cases, that only takes like 6 months to a year if you're in a really high paying job. In other cases, it might take like 4 or 5 years, right? But even if it takes 1 year, and let's say you're living on the coast, you're buying a $1 million home, 1 year appreciation might be $40,000 just in the purchase price, right? And then multiply that with, I don't know, 2, 3 based on the mortgage. It can be a very expensive decision to delay buying a house. If you already know, I'm not saying go buy any random house, but if you kind of know you're in that direction, thinking about that post graduation, it might be worth saving some cash for that too, right? So cash is king is not lightly taken. I think the later you go in your career, the more life goals that show up, the more cash is king has value. Okay. All right. Finally, I'll share this slide. This is the interesting slide. I added this slide, and you can see I say don't stress, right? That's the whole point of this slide. It's like after going through all of this, a lot of people look at the loan amounts that they're considering and they're like, oh my gosh, like this is crazy. Who's going to take $200,000 in loans, right? And the answer is everyone. Not everyone, but like 30% of people, right? The people on this right side here are kind of taking like the full cost of attendance, right? And these numbers don't include, in some cases, an additional $20,000 that people are taking from the federal government. So these are the private loans that people are taking through Juno. And then some of these people are taking an additional $20,000 from the government. So in many cases, people are taking, $200,000 plus by the time they graduate, roughly 30% of people. And then on the median, it's something like $130,000 by the time you graduate. So and then I don't have the data to back this up, but anecdotally, when we speak to lenders, you guys do well in repaying the debt. It's not unusual to repay the debt in 6-7 years. In some cases, international students actually repay the debt much faster, just because the interest rates for international students sometimes is higher. And in those situations, they're like, I just want to hammer at this debt really fast, right? They go on a ramen diet and they just knock the debt out in like a couple of years. So yeah, hopefully this is meant to say, like, don't stress if you're taking a large amount of loans. All right, so that's my spiel on how much you want to borrow and then where you want to borrow it from. Diego, should we pause for some questions on how much you want to borrow? Are there some thoughts about that in the chat?
I've been answering a few of them already. I guess I wanted you to get to this slide because there's some questions about credit score and how is that assessed, I guess, when you're shopping on the private market. So I think this is a perfect slide to touch base on that.
Yeah, actually, the webinar we did yesterday, that deck has some good slides on that too. I might pull that up. If you have it handy, put the
I'll look for it. Yeah.
Chat it to me in Zoom privately, right? Okay, so where can you borrow from, right? The most popular options are basically on the screen, right? The federal unsubsidized loan, you can borrow up to 20,500 through that loan. The interest rate changes each year, but it's the same for everyone, right? So this year it's going to be 7.94%. Last year it was 8.08%. So it's roughly remained the same between last year and this year. And the origination fee is 1.08%, right? So there's the grad plus loans, and these are used if you need to borrow more than 20,500 from the federal government, right? The interest rate on that is higher, it's almost 9%. The origination fee is dramatically higher, 4.28%. And that's kind of the federal loan options. Your credit score, etc., all that doesn't matter, right? There is some cases where you may not qualify, but they tend to be very rare, right? Like a bankruptcy situation, things like that may disqualify you from getting the federal loans. But largely, if you're a US citizen or a US permanent resident, you're very likely to qualify for these loans. The private market comes in here, and for a good chunk of people, well, I'll say this, for Juno, right? For the deals that Juno negotiates and makes available to you, a large majority of people are able to get rates that are better than both the grad plus loan and better than the unsubsidized loan, right? Roughly, we think of it as like if you have a 700-ish plus credit and decent income compared to your debt, we probably beat both these loans for you. Let's say, and even if you don't have an income, and let's say you have like a 730, 740 or above credit score, we tend to think we'll beat both these options for you, right? In terms of the interest rate. We don't have any origination fee, so that's additional savings on top of that. Then you're like, wait a second, why doesn't everyone just use Juno, right? And it comes down to this last line of like the benefits that the federal loans have that no private loan has, specifically public service loan forgiveness and income-driven repayment plans. So if you're going to pursue a career where you might go into nonprofit, or you might go into hospital systems, or you might go into working directly for the federal government, etc., you might qualify for public service loan forgiveness. And obviously that can be very attractive, right? Public service loan forgiveness works like, you make X number of payments on time, and then at the end of it, your loans are forgiven. Income-driven repayment is different. Income-driven repayment is often used in conjunction with public service loan forgiveness, but it's basically helping you manage periods where you're not making much money, right? So if you have a low in like doctors, for example, graduate into residency where they're not making much money, but then their incomes take off after 3-4 years of residency. So in those cases, for that time that they're in residency, they are often on an income-driven repayment plan, and that allows them to make small payments instead of large payments. On many of these income-driven repayment plans, the interest continues to accrue. So it's not like you're saving money per se in the long run, but you are managing the situation in the short term because the amount due is not very large, right? So then you're like, what happens with private student loans? If I lose my job, I'm just like, I instantly default? No, that's not the case, right? So with private student loans, let's say you have a tough year, you have a layoff, something happens, right? You can usually call the lender and ask them about your options. A fairly common option that we hear about is like 12 months of forbearance, right? So they're like, okay, You lost your job, you don't think you can make payments right now, we'll put you on forbearance for a few months, right? Some lenders will say, oh, can you have a reduced salary. Okay, can you make the interest payments? Forget about the principal for now. Just can you make interest only payments? So that kind of stuff comes up. But it's a discussion with the lenders, customer service team, as opposed to with the federal loans. It's like it's your right, so you can just apply for it, you get it, and then it's done. So that's kind of the difference you have to think about in terms of managing, periods of uncertainty, right? The other thing we see is like many times, this kind of sensitivity matters in the few months post-graduation. Once you start building up your emergency fund, kind of doesn't matter, right? And both federal and private loans don't require payments up to 6 months post-graduation. In case of private loans, sometimes up to 9 months after graduation. So that's not really the period to stress about, right? It's really post 9 months after graduation. At that point of time, if you still haven't started demonstrating an income, that's when things start get a little bit challenging, get a little more challenging, right? So that's the trade-offs there that you want to think about. Again, with MBA programs, we see very wide adoption of Juno's loans. With other graduate degrees, depending on the degree, depending on the school, there's mixed adoption, right? Everyone here is MBA, right, Diego? That was part of the yeah. So I've kind of outlined it already, but essentially, if you need public service loan forgiveness or income-driven repayment plans, you're probably just going to take the federal loans because that's the only place to get it. If you don't think you need those features, optimize for cost, whichever one is cheaper, go ahead and take that. Obviously, we expect Juno to be your most affordable option. The other question we get is like, hey, I'm comparing this private loan with this federal loan. How do I take into account this origination fee, right? So we did some math here. When you get the slide, you can take a look at it. It kind of depends on how long you plan to keep this loan. What if you keep it for the full 10 years, which is like the standard repayment plan, the effective rate is like roughly 10%, right? But if you refinance around graduation, which is common because, for example, the rates people are getting right now, if they take a student loan for like going to school, like 7.5%, right, on the median. A little bit lower actually this year. I think maybe closer to 7% on the median. Versus if you are graduated and you have an offer letter in your hand, you might get like 5.5%, 6%. Right. So this is substantial savings you might achieve by refinancing your loan. And because of that, a lot of people refi. So that means you're only keeping the loan you're taking right now, potentially for 2 years. And if you're a second year student, like 1 year, like less than 1 year, like 9 months. So in that case, that origination fee hits really hard, right? And the effective rate shoots up. So yeah, again, like we expect just the pure interest rate to be better than the federal loans. So oftentimes you don't even have to think about the math. But in case you get a low rate that's between 9 and 10%, for example, then you might want to do some math like this. All right. Good time to pause, Diego, or what do you think?
Yeah, I think I just want to clarify because I'm seeing a few questions about internationals on the chat. So I guess you want me to take that one real quick?
Yeah, you're the expert here, Diego.
All right. Well, as you probably saw at the beginning of the presentation, I was an international student myself, right? So basically, international students have more limited options on the private student loan market, right? So in some cases, you might see one lender, two lenders, or up to three lenders, depends on the school you're going to, basically. So when we try to work with international students, we try to get everyone to get a US cosigner. Why? Because the difference in rates you might see is substantial, right? Like think of low teens on an interest rate versus what Nikhil was saying, 7%, right? So, and when you take into account the amounts that international students are borrowing, which I don't think we have the data, Nikhil, but I'm pretty sure it's higher than the average, right?
No, we've looked at the data. I think the average for domestic students is closer to like 65, And the average for international students closer to either 85 or even higher than that. Yeah.
Exactly. So, it's 1% of the interest rate for international student, weights even more, right? So the point here is, if you have any chance of getting a US cosigner to work with you, then you'll be accessing, I guess you have access to Juno's main deal. If not, we'll try to guide you through your best options, but it's just not going to be a negotiated deal, like the one we have if you were to have a cosigner. In any case, anyone with any questions specifically about internationals, shoot me a note. I'm dropping my email here in the chat, and I'll be happy to take a one-on-one calls with anyone that needs it.
Yeah, and we're happy to basically handhold you through the process, whether it's with a cosigner or without a cosigner. All right, let's talk about what we've negotiated, especially for the folks who are, sort of entering this fall in a few months. So this is sort of specific for them, but honestly, it holds true for many years that we've done this, right? For the last 7 years or so. So yeah, we expect the rate we've negotiated to be better than pretty much any private lender out there for MBA students. What MBA students often see is like they go and try to apply for a loan. Many places will just decline them if they apply without a cosigner. And when they apply with a cosigner, which they don't want to because they're later in their careers, they don't want to ask their parents at this point, they might not have a spouse yet, like various reasons. We see around 67% of people apply without a cosigner, right? So yeah, and plus a lot of lenders out there don't understand graduate students or MBA students. Juno's like 80% of our business is MBA students, right? Or graduate students plus MBA students mostly, versus for like pretty much every lender out there, 90% of their business is undergrads and like 10% is grads, and MBAs are like 2%. So they don't really understand that customer. They don't know how to underwrite that customer. But when we work with the lending partners we select, we basically get them to understand you better, and therefore that results in basically giving you credit for the amazing careers you're very likely to have in the future. So what we've negotiated this year is two deals. Lender A, very easy to qualify for. They give you rates below what they give on their own website. So if you went to the lender's website, you get X. If you go through Juno, you get the same loan, but the interest rate is less, right? And if you find a better rate than what that lender is offering you, we'll match it. So we'll give you the same rate and cut your check for 1% of the loan amount. So that's an amazing deal in and of itself, right? What we did do though is we tacked on the second lender. The second lender has even lower rates for some people, okay? These get into the sixes very commonly, right? But it's harder to qualify for. Okay, it's we are seeing right now, I think 40-ish% of people end up qualifying for this lender, versus lender A, it's like 90% people are qualifying, right? Like I don't quote me on those exact numbers, but you get the idea, right? It's significantly different. Like with lender A, if you have no income, no problem, right? Like you're still very likely to qualify. With lender B, if you have no income, you probably just don't qualify, unless you have a cosigner who has income, right? Something like that. So yeah, and then we also have a third deal, which is really special for Texas residents. Again, the rates are great, phenomenal rates, to be honest, on that deal, even lower than lender A or B. But it's only available to people who are either going to school in Texas or have a driver's license that has a Texas address on it. Okay. So that's kind of the deals we've negotiated. This is kind of what we expect to happen, right? If you have a FICO higher than like 700 or so, we expect we are just going to beat both the federal options, right? If you have a FICO less than 700, we think, we'll beat the we don't know, I guess, is what I'll say, right? We don't think we'll beat the unsubsidized loan, and we may or may not beat the grad plus loan for you, right? And then in terms of tech, if you're in Texas, then we think we just beat everything outright, just because it's easier to qualify, great rates. It's kind of the best of both worlds. And lastly, like I mentioned, if you find a lower rate elsewhere, one of our partners will match it, and then we'll send you a check for 1% of the loan amount on top of that. Basically makes it impossible for you to get a better loan anywhere else. Right? It should be impossible for you to get a better loan anywhere else. Yeah, so we strongly encourage you to go, especially if you're fall 2025 admits. Go to juno.us/Leland25. Sign up. If you're not fall 2025 admit, go to juno.us/future. Submit your information. That way we'll stay in touch with you. And yeah, let's focus on questions.
I guess there's one here, Nikhil. Would you mind walking us through, I guess, how much time does it take for someone to get approved, assuming they're accessing one of the deals you just presented?
Yeah, absolutely. So with lender A, if you're applying by yourself without a co-signer, we are typically seeing instant approval. So like 15 minutes, call it, right? So 15 minutes for you to fill the form, you hit submit, you're approved. If you are applying with a co-signer, we see roughly like 2 business days. So you fill out the form, your co-signer fills out the form, you both hit submit, and then it might ask you for like pay stubs or something like that. You upload your pay stubs, then you can let it sit for a couple of days, and then they approve you. With lender B, we are seeing like 3-4 days in terms of timeline over there, and so at worst, call it a week, right?
And I think it's important to know that you can get approved right now, right? And the loan's not going to get funded until closer to when you start classes or your tuition is due, right? So one of the important things that you were mentioning before is you will not start accumulating interests until that money is sent to the school, right? So yeah, that's a very important thing to keep in mind, because there are movements in the rate throughout the summer. You would be better off applying right now, right? Avoiding, let's say, rates increase, you'll be happy you apply right now. If rates decrease, you can still reapply again and get a lower rate.
Exactly. Yeah, it's always in your best interest to lock in a rate right now, and then if it goes down, you can adjust, and if it goes up, you're happy that you already locked in a rate, right?
Someone's asking if the rate for Texas residents is also going to be available for next year, like if someone's planning to, enroll in fall 2026.
2026, we'll find out in 2026, but yeah, I think the Texas situation is very special. I think it's going to be quote unquote forever, which right? I think that's a very strong program. It's a repeat partner. This deal existed last year. We renewed the deal with this partner. They're extremely happy with us. I think $20 million of loans or something like that. So they're extremely happy with that, and so I think on both sides the relationship is working very well. I think it'll continue into next year.
Yeah.
And it's very difficult to for a new lender to come in and beat that lender. It's next to impossible, right? So I don't suspect they'll get booted from Juno because some better lender came around. It's as far as Texas is concerned, they've gone out of the market.
There's someone asking if you can kind of weigh in on how much they should dip into their savings, 401ks versus borrowing. I guess you touched base obviously at some point in your presentation, but any additional insight you can share there?
Yeah, I would not suggest touching your 401k, right? Like if you're talking about 401k, Roth IRA, traditional IRA, any kind of retirement account, right? I would not touch that. You probably end up with a penalty. The only exception might be the Roth IRA. You can take out contributions without um, getting hit by the penalty. But even then, it's really expensive, right? You're losing out on post-tax money growing tax-free for 30 years. Like, oh, do the math on that, and there's no way you should be taking that money out, right? So I would not touch any retirement account whatsoever. In terms of a brokerage account or cash, I think it depends on the interest rate you get, right? Personally, if I'm getting an interest rate like 6-7%, and I expect I can refinance it in a couple of years to 5%, I'm just gonna borrow and let the stocks grow, But if I'm risk averse, or if I have this, some people have like a heavy psychological burden when they have debt, right? In those situations, it might be better to burn the assets as opposed to like take on debt, right? So, um, personally, I have about $90,000 of student loans, 5 years post-graduation, right? And I keep that debt not because I can't pay it off. I have enough savings now to pay it off, but it's more that I don't see value in paying it off. I'd rather keep that debt around and let my money work harder, make more money, than not having that cash. Right?
Yeah, I think that's a very smart way of looking at it. I will just emphasize on something you touched base at some point in the presentation. Keep a savings fund, like, keep your cash on hand. Like something that helped out to me a lot was like 6 months worth of my cost of living. I just set it aside on a savings account. I actually haven't touched it to this day. Because like you were saying, right, you don't want to plan to go broke at graduation, right? So that worked out for me very well. And I have friends from school that they were struggling the last month of the MBA, try to get more funds because they didn't plan ahead, right? They didn't have that, rainy day fund.
Moving expenses to the new city, right? You didn't
Exactly.
find a sublet on your apartment and you need to figure something out.
Job offer starts until August or September or even next year, so you won't have any income in the next few months. So yeah, plan ahead for that. There's a question from Katie here, actually, a very good question. She's asking about is it worth it for her to add a cosigner, right? If she has the option of adding one, like what's the impact of adding a cosigner?
Yeah, this is a great question. So if you yourself have a strong credit score and you yourself have a great income, right, compared to your debts, there's likely not much value in adding a cosigner, right? Like the value in adding a cosigner comes if your profile is significantly worse than the creditworthiness of your cosigner, right? The larger the gap, the larger the gap in the interest rates. But if you already have a great profile and then you add another great profile next to it, like that doesn't change anything, right? So it's not like, you get a lot of credit for just having a cosigner that looks like on your creditworthiness scale looks the same as you. Yeah, there's not much. What we suggest at the end of the day, right? It's actually very hard for someone to gauge themselves, whether they are a strong borrower or not, right? Like I know a lot of people on this call is going to disagree with me, but the number of phone calls and messages and emails I answer where someone says, "Hey, I'm a great borrower. Why didn't I get the lowest rate?" Right? Um, it is very, very large, right? That tells me people overestimate how great of a borrower they are. The median FICO in this population, I'm speaking about MBA, incoming MBAs, right, is roughly 780. Now, when we take that in the context of like the whole US population, yeah, 780 is an insanely high FICO. But in the context of incoming MBAs, that's median, right? So, just don't try to guess whether you're a great borrower or not. What we suggest is there's a tool we've built specifically for this, right? Go to Juno you find the rate check tool, that's what it's called. Find the rate check tool on our website. It's a one-page form. You fill it out, you submit it. We do a soft credit check. It doesn't hurt your credit score. We do a soft credit check and we'll show you exactly what rates you qualify for. Then click on edit. And at the bottom of it, there'll be a checkbox that says, I'm not using a cosigner. Uncheck that box. So now you'll see fields for your cosigners, first name, last name, whatever. Fill out that, hit submit again. Now you see the rates with your cosigner, right? If you have 3 different cosigners you're considering, repeat the process 2-3 times. Just look at the rates and then decide, is it worth applying with the cosigner, or is it worth just proceeding by yourself? We find that in many cases in this audience, it's just better to go by yourself. There's not that much benefit. But if you find yourself in a situation where you have a much stronger cosigner available to you, go for it.
I think that's a great answer. Last question here. I know you're going to spend a few minutes on this one, Nikhil. Someone's asking like, hey, if we want to borrow more than the cost of attendance, I guess what are their options, right?
Yeah, that's a tough one. So look, the starting point is like cash, savings, stocks. And obviously you're asking me this question because like, those obvious options are not available or not enough, right? There is this hack that I always get asked about and I always hesitate to talk about, but I'm going to talk about it. It's not risk-free. It's a very risky thing to do. Okay, I want to start with that. It's a risky thing to do, but it is something. Oh, yeah, someone just posted about it, right? Okay. So what you do is you take this 0% APR credit card. Okay, so this is a credit card that basically says, hey, for the next 12 months, you can make purchases on this card, and you don't have to pay off the balance every month like you normally might do with the credit card. You can just let it sit there, and we're not going to charge you any interest. But if you haven't paid it off by the 18th month, we're going to charge you like 25% interest, right? And you have to be very careful with these cards because some of these cards, not the most popular ones, but some of them, the sneaky ones, they'll have a clause that says there's no interest if you paid off in full by X date, right? Whatever, 18 months, 16 months, 15 months. But if you reach that 16 month and you've not paid it off, we're going to charge you interest for that full 16 months, right? That's crazy. So you want to be very careful with these credit cards, right? They are a gotcha kind of situation sometimes. But yeah, a lot of people, not a lot, but some people, what they'll do is they'll open a 0% credit card, right before they leave their current job, right? Then they'll use that credit card through their first year of the program. During their internship, they'll live a little bit frugally. They'll pay off that credit card, whatever the balance on the credit card is, right? They might open a second credit card to get them through the second year. A key point to make is they will usually pay down this credit card before they apply for the second year of student loans. Because if you have a high balance on a credit card, that's going to impact your student loan rates. So they'll in the internship, they'll pay down the credit card, then they'll apply for their student loans. They'll get a second credit card for their second year. They'll go through their second year, they'll graduate, they'll use their signing bonus to pay off the credit card, and life goes on. So like, it's a strategy, it's risky, it's not easy. There's no harm in putting it in your back pocket, right? Like if you feel like you might end up in a situation where you'll be in a cash crunch, open the card, put it in your pocket, don't plan to use it, but it's kind of like your emergency fund, right? If you are going in planning to use it, recruit hard. Make sure you land an internship income, internship that has strong income. Make sure you pay off that credit card. Don't put yourself in a situation where, your usage of that credit card is now costing you thousands of dollars more than you anticipated because you couldn't manage to pay it off in time. Okay. Hopefully that helps. I don't mean to scare anyone, right? I'm just trying to create the appropriate amount of caution in using a strategy like this, right? There is a risk involved here in the situation getting expensive really fast.
I mean, the other solution is just scale down on the social life a little bit.
Yes, that's the other solution. It's not that's equally hard, I think, just because you're surrounded by so
Well,
much bad that's happening.
I think we're very close to the mark, Nikhil. I don't see any other questions here. Thank you, everyone. I see Oliver with your camera on. Thank you for having it on. And yeah, thank you to the Leland team. I don't know if Amanda's listening, but pretty sure you'll get the recording tomorrow.
All right. Bye, everyone.
Awesome.
Thank you.
Thank you.